G'day, my name's Ben Everingham and I'm the director here at Pumped on Property, and in today's video I'm going to talk about the 7 things every property investor needs to know to beat market averages. So this is definitely going to be one of the highest quality videos I've ever produced and I'm very excited about it. We're going to talk about buying houses, metro markets, the inner, middle and outer rings. We're going to talk about how to get above average returns and timing the cycle. We're going to talk about the global cycle, and we're going to talk about which markets in Australia to invest in which times during the cycle. So these 7 things are pretty much my absolute personal guide map when I'm buying property for me and for my clients. So I hope you get some value. If it's your first time to my YouTube channel or blog, welcome. Really excited to have you here. It would be great for you to subscribe. Done heaps of really high quality videos like this one. So like I said, the title probably doesn't tell you enough about what I'm really going to talk about. These are literally the gold nuggets or the silver bullets in property investing. For anyone who's really serious about investing in property, this is the need to know stuff. So the first thing I wanted to talk about is buying houses. Now, based on some data that I've recently collected from RP data, it looks like houses in Australia have outperformed units by around about 1, if not up to 3% per annum for the last 20 years in some of Australia's marketplaces. So just think about that for a second. Any investor that understands the value of compound growth, and I'll give you an example of this now. Let's say that you were to buy a property for $400,000 today and hold it for the next 15 years. And one example was a unit that grew by 4% a year. The second example was a house that grew by 6% a year. The difference in terms of getting a 4% return on your money or a 6% return on 400K over 15 years is over $235,000 of missed growth by spending the same money. So if you think about a 1 to 3% difference, you're costing yourself really big money by rolling the dice on units. So buy houses is the first part of the 7 things that you need to know. Now, not everyone can afford houses. Stop using that as an excuse. If you can't afford a house in Sydney or Melbourne right now, go buy a house in Brisbane, you know what I mean? If in 10 years time you can't afford a house in Brisbane, go buy a house in the next biggest regional city. So houses should be the focus, and it's much better to own one quality property than a bunch of crappy little properties. Now, the second thing that I wanted to talk about is buying metro. So again, according to RP data, over the last 20 years, the metro cities of Australia, so let's call it Australia's 7 biggest capital cities, have grown on average over the last 20 years by 252%. Now, for anyone who likes to think like a computer and thinks about compound growth, man, I would have loved to have been buying 20 years ago. Even if the next 20 years is half as good as that, I'll be absolutely through the moon. If we look at the regional markets over the 7 or 8 biggest regional markets in Australia over the same period of time, they've on average grown by 167%. So we're talking about a 90% difference, or a little bit over 90% difference in the performance of capital cities versus regional markets. Now again, not all of us are born with a silver spoon in their mouths. Some of us, like myself, have to work hard, and every dollar that I make and invest is meaningful to me. So again, if I'm talking about 90% over 20 years, which is over 4% per annum, why wouldn't I be investing in capital cities? And I'm really talking about here, Sydney, Melbourne, Brisbane, which have done the best. You know, Perth is expected to get some long-term population growth, but if we know in the next 20 years, 75 to 80% of Australia's population growth is going to be Southeast Queensland, Sydney and Melbourne. You know, I just don't roll the dice against this stuff. There's so many people that want to reinvent the property wheel and get rich quick. I just want to do what actually works and what's created wealth for a lot of people. So the first thing I talked about was buying houses. The second thing is buying metro markets. So they're 2 really important foundational things that you need to really focus on. Again, if you can't afford a house or a metro market, sit on the sidelines for a while, because even if you miss 10% growth in the first year, over the next 20 years, you've just seen what it can cost you by buying that type of product. Now, the third thing I wanted to talk about, and this is something I literally just learnt this morning, which I'm so excited about, and that is buying inner and middle ring suburbs and as opposed to outer ring suburbs and regional areas. So Michael Matusik sent out an amazing newsletter this morning. Highly recommend subscribing to his data. He's incredible, where he looked at the 7 or 8 capital cities of Australia, depending on who you add to that list. And what he looked at was the growth in the last 10 years of the average price growth of an inner property, houses, a middle ring property and an outer ring property. So let's say the inner ring might be within 5Ks, the middle ring might be 5 to 20Ks, and then anything outside of 20Ks is the outer ring. And what I found from looking at Michael's data was that in the last 10 years, the inner and middle rings have performed almost 1, if not 2% better than the outer ring suburbs. So again, if you're targeting houses, if you're buying metro property and you're buying inner and middle rings, they're probably the 3 things, if you're a long-term buy and hold investor like I am and you like quality property, to never ever deviate from again if you can afford not to. The 4th thing I wanted to talk about in this video is some individual research that I've done, but I originally collected the data from Homely, who collected the data from RP Data and the Australian Bureau of Statistics. And what it did is it looked at the Sydney, Melbourne, Brisbane and Perth markets year on year for the last 46 years from 2016. And what I realized is, 1, if you hold property long term, the average return in all 3 of those markets has been over 8% per annum, which is incredible. But what I did is I analysed all of the data in each of those cities year by year, and I found out that 65% of the time for the last 46 years, if one of those 4 capital cities has had a 10% citywide capital growth year, which means the average property in the city has grown by 10% in a year, that next year after that, there's a 65% chance that you're going to get at least another 10% growth year. And often that 10% growth year can run for between 2 up to 7 years. So in terms of timing markets, this is really, really important data. The other thing about getting a 10% growth year is that 89% of the time, based on mine and Ryan from On Properties analysis of this data, is the next year after a 10% growth year is going to be up 89% of the time. And if the market did decline the year after, within 3 years, property prices will be back at that point again. So this is really that peace of mind stuff and understanding when to enter marketplaces. So for me, who's overlaying a global cycle with a national cycle, when I think about Brisbane, it's 2018 at the time of recording this, it has been completely flat for 10 years, which means completely flat, according to CoreLogic's a 1.5 to 2% average annual growth rate. According to me, it's just a year without a 10% growth year in it. I'm really, really excited about that next 10% growth year. And the reason I like this 10% growth year, just as a rule of thumb when analysing and looking at markets that you're going to enter or exit, is that people are like sheep, unfortunately, and Australians love backing a winner. Think about cryptocurrency in 2017. Think about Sydney from 2013 to 2017. Think about Melbourne from 2013 to 2018. Aussies love a winner. Think about the horse that's going to run in the Melbourne Cup that hasn't lost the last 20 races. We just get on the back of that bad boy and we just flock like sheep straight into the market that's performing. And if you don't believe this, look at the way that Hobart has performed in the last 3 years. It had its 10% growth year. Everyone in Australia, even though the population is declining there and there's no jobs, think that they're onto a winner. They all get their money down there, and now the run has lasted between 2014 and 17 and will last into 2018. So if you're an investor like me that wants to do the best you possibly can, get in on the first year of that 10% growth year, obviously overlaying all of the other really, really important things like the global cycle and the local cycle on top. Now, the 5th thing I wanted to talk about in today's video is this global cycle, and that is really, this 17 to 21 year big picture cycle. And if you're not familiar with this cycle now, take a look at Phil Anderson's videos or his book, The Secret Life of Real Estate and Banking, or take a look at Fred Harrison's book, The Power and the Land. Fred Harrison predicted the recession that we had to have in the 80s 8 years before we had it. Phil Anderson predicted the global financial crisis 3 years before we had to have it. So these guys are people that look at the history. Phil's book looks at 250 years of booms and busts relating to property and the stock market in America. Fred's book looks at 350 years worth of booms and busts in the UK. So what's interesting, if you know your history, is that the Australian market has loosely followed the American market cycle within about a year for the last 200 years. So, you know, there's no book on Australia yet, but it's really interesting to just understand this big picture cycle stuff. So knowing that we have a major correction once every 17 to 21 years means that you can aim as an investor to buy at the bottom of the cycle and ride the wave up, or as an investor know when to sell out or to just decide to hold through knowing there's going to be some bad years. And really, really interesting data. Every single investor that's looking to get above average market returns needs to understand when to buy and when to sell, and that big picture strategy can be really useful to help with that, obviously overlaying that local Australian market stuff on top of that too. Now, the sixth thing that I wanted to talk about is some data that I recently looked at from RP data again, and they basically produced a really, really cool article called Mind the Housing Gap recently, which looked at the last 20 years of property price growth in the 7 capital cities around Australia. And what I realized when I overlaid Phil Anderson's bigger picture stuff is that after the GFC and after the recessions that we have to have, Sydney and Melbourne, because they're such economic powerhouses compared to other cities in Australia, always recover in the first half of the cycle, the first 7 years, significantly better than anywhere else in Australia. So what that means as an investor is when we come out of the next global financial crisis and we know that property prices have bottomed out and they might have lost 10% of value, they might have lost 50%, don't freak out about it. Read Phil's book, you'll feel much more comfortable. But, you know, let's say that you buy a property in Sydney 30% cheaper in 8 years' time than you could buy it for today. And let's say over that first 7 years after you buy that property 30% cheaper, it goes up in value by 40 to 70%, which has happened in the last 2 cycles at least. It's even grown by 100% a couple of times. But, you know, use that information to know that timing-wise, you get into Sydney and Melbourne straight after the GFC. And then what's equally important, and this is the 7th point, is that after we go through this, you know, the correction in the cycle, which was the GFC, and remember from GFC to GFC, we're talking about 17 to 21 years. So we've still got a lot of time left in front of us now before we go through the next major global one where America and Europe and everywhere else gets smashed, including Australia. But what happens after that Sydney and Melbourne run is that prices get so expensive and unaffordable that people can't afford to live there anymore, can't afford to buy there anymore. And in the second half of the cycle, which we're just about to go through, the other capital cities in Australia and the other major regional markets, think Wollongong, Newcastle, etc., perform much better than Sydney and Melbourne. Now, this is based on the last 20 years and the last 40 years worth of data, but the past doesn't always perfectly repeat itself. You know, think Newcastle and Wollongong, they've almost received the same amount of growth as Sydney has in the last 7 years. So it's going to be interesting to see what happens over the next 7 years, if they can do that or not. But really powerful to know in terms of an investor who's looking at timing specific markets. And I sort of overlaid the Heron Todd White report on this, and I could see that Sydney and Melbourne are either at the peak of the market, approaching peak, or are actually starting to decline, where all of these regional markets and other capital cities, you know, outside of Perth, are in that really sweet spot to take advantage of the next 7 years. So really powerful stuff. I know I've explained a lot in this video, and these are some really big ideas, but, you know, reducing those 7 things back: buy houses if you can afford them, buy metro property if you can afford it, buy inner and middle ring suburbs if you can afford it. Know that when we get a 10% growth year, the likelihood of another 10% growth year is about 65%, and that is a really decent indicator to look for if you're considering entering a new market like Brisbane that's been flat for 10 years right now. know that we have a major correction every 17 to 21 years, and to expect it and to capitalize on it. Your job right now is to get set up for the next correction. So when that time comes, you've got good cash in the bank, you've got good equity, and you've got good cash flow on your investments, and you've got a low LVR, so that you can go into the marketplace and buy when other people can't. Obviously, Sydney and Melbourne perform much better coming out of a correction in the first 7 years, and then in the second half of the cycle, the regional marketplaces and your other capitals like Brisbane and Perth historically have performed better. So a lot of this stuff is based on history. No one can predict the future, but what we can do is use history to educate ourselves, and we can look at the type of product that performs the best. I really hope you've got some value out of today's video. Now, any of you who are looking to take advantage of the second stage of this cycle that we're moving into from 2018 to 2024, I'm a buyer's agent. I work specifically in the Brisbane market, was obviously specifically in the Sydney market during the first stage of this growth cycle we've just gone through. But I'd love to offer you a one-on-one strategy session where me or my brother Simon will learn more about where you are and where you want to get to in the future and how to bridge that gap. Obviously, property is purely a vehicle to work towards financial independence, but it can also be a lot of fun investing in property too. I take an extremely low risk approach to investing in property personally. I really don't like debt. My strategy for buying properties for myself is always get good cash flow, always focus on capital growth, overlay the timing and the strategy that we've talked about in today's video, and find properties that I can add a little bit of value to over the next 10, 15, 20 years. But if you'd like that complimentary strategy session, please jump over to www.pumpedonproperty.com, and hopefully we can talk about how you can take advantage of all of this amazing information that's out there and use it to your advantage to set yourself and your family up for the future. So until next time, thank you and have a great day. Bye.